Let me bring on board, as promised, Big Market Voice. Joining me is Feroze, Azeez, Joint CEO at Anand Rathi Wealth. Feroze, always a pleasure chatting with you. It's a rainy day here in Mumbai. Almost, been pouring since the time I woke up. It's a red alert. And, same thing goes for Dalal Street. We've seen some bit of outpouring of gains, right, of the last 8 sessions. Today being a day of breather. Of course, we've had reforms in the form of GST cuts, but this week Fed will take center stage. What are your thoughts? 25 basis point baked in, or is there an outside chance of a 50 basis point rate cut, given the fact that there is ample pressure coming in from Trump?
So I think 25 bips is, in my opinion, best case situation. I go wrong several times when you're predicting closed rooms behavior. It's very difficult to predict that. Total market sentiment behavior is still a predictable variable, as you could see. So I would say 0.25 is what I would vote for, 0.1. 0.2, looking at the kind of numbers which are flowing in, I personally think these rate cuts and the pace at which those rate cuts will happen will be a lesser long-term variable for how the US could impact Indian or emerging markets. I was in the US last week. When you're meeting investors, what I get a sense that the different spillover effects, or at least on the negative side, which US can throw up for emerging markets, is the immense leverage they're sitting on. That's point one. And second is, how would Fed roll down its balance sheet? They have about papers of 6.5 years is the modified duration of the Fed's balance sheet. How do they roll it down? Do they QT, or do they just hold to maturity and roll down their balance sheet to half the size? Is what will be interesting. And the kind of leverage which US is sitting on, you would see some technology stocks which went up dramatically. That's a very high short gamma market. What that implies is a separate story, but that's the two things which I would watch out from a medium-term investor's perspective, or as a cue from US to Indians.
Sure, Feroze, there are, of course, concerns around, Trump's tariff also, facing a legal setback, right? How concerned are, foreign investors about that in terms of US deficit? Because, we will still be awaiting a verdict from Supreme Court in that sense, right? So, do you think there are fears around US deficit in that sense?
See, US, as long as it's a reserve currency, there is not so much of a problem with the deficit per se. Of course, the kind of borrowing they have, $37 trillion of borrowing, and they're adding to the deficit, of course, is a long-term problem. But I think for a country which has the reserve currency in their control, till that remains, I don't see that as too much of a problem. What has US done has, over the last 2-3 decades, it's always deferred the problem by using and capitalizing on this fact. In 2008, they printed money, saved a lot of corporates. In COVID, they gave a lot of money directly to bank accounts. In fact, some of my NRI or green card holders or US citizens who were in India were getting credits in their bank accounts as a COVID support. So surprising, and you would have about $100 million as an investment in India. So point I'm trying to make is they've always tried to pump in money and capitalize on their status of having the reserve currency under their control. So deficit is not so much of an issue, but I think the Fed balance sheet squeeze, how it will be brought back to normalcy is something which I would always watch for.
Okay, so what's the sense you got from FIIs when it comes to India and the flows into emerging markets? Do you think a Fed rate cut would move the needle? Because there is some bit of thaw also emerging, right, between India and US, given the kind of tweets and commentary from both the sides. Would that move the needle? Because they've already pulled out a sizable amount from the Indian markets. And that's a piece of the puzzle that's been missing for us this entire year, FII flows.
Yes, Nandita, see, if you look at how FIIs are being looked at in India, they have to be broken down into 3 parts. Okay, FII, one name fits all. It doesn't work that way, in my opinion, because there are active FIIs, whom I met about 8 of them in the US. There are index fund investors who are FIIs again, but they are not assuming any discretion. The third is prop investors, especially those institutions which have their pension funds and stuff being invested in India directly for themselves, not for a fund manager. So the active fund managers who have quit India or largely quit some stocks which were absolutely overvalued because they have several other options in the form of emerging markets. They're actually not so valuation sensitive as much as we believe they are. They are very growth sensitive. If any sector is not throwing up growth, they are not wanting to hold that. And I think that is the key issue. And there are some sectors which are now promising growth, and that's where you will see a lot of these actively managed funds who have billions of dollars invested in emerging markets will move some money. Last 1 year, the growth has been disappointing in several sectors, is why I think they've moved out. So they're very agile. They will come back. They're not so valuation sensitive. As long as you give them a 20% growth business, they're ready to buy it at 50, 60, 70, 80 PE also. As long as the 20%, 25% growth is sacrosanct for 5, 7, 10 years. So I personally think the needle will change. To answer your question, I think they will come back as soon as growth becomes a little more promising, which was not the case for the last year and a half.
Okay, of course, we tend to highlight the fact that, FIs are concerned about Indian market valuations, and that's a new perspective or fresh perspective that you've shared with us. Before I come to sectors, Feroze, we've had a SEBI board meet on Friday. Quite a few, sweeping changes announced by SEBI. They've relaxed the minimum public shareholding norms as well, and even in terms of easier norms for, foreign investors. They've kind of approved the single window automatic and generalized access for trusted foreign investors. How do you view these measures that SEBI announced? How do you think what kind of implications would that have? A, on FII community, and B, because of the easier minimum public shareholding norms, do you expect it to unlock a fresh wave of IPOs? We've already seen quite a few big ticket ones. But what's your sense going forward?
Yes, Nandita, just to wrap up on the previous one point where I'm saying that FIIs are not so valuation sensitive, if you just are able to get a hand on these active fund managers and their portfolios, you will see several high PE stocks in them which are actually delivering the growth, which proves the hypothesis. Most of us go with perception that valuation ज़्यादा होगी इसलिए बेच दिया होगा, क्योंकि हमें सुकून मिलता है उस आर्ग्यूमेंट से. बट इफ यू लुक एट देयर पोर्टफोलियो, दे हैव their average pre's are not as much as a value sensitive investor, so that's the point. Now coming to how I see all these developments, of course SEBI's board meeting had several things. One is from the cash market standpoint, one is the long term derivative standpoint, one from the investor and the mutual fund fraternity and the investor education standpoint, new investor creation standpoint. So it covers a wide gamut of things, right? If you look at from a development standpoint, SEBI is doing very, very good small steps which will add up over long periods of time, and that's what SEBI has been doing. And I really respect SEBI for that, because if you see incremental changes, Indian investor is going to pump in 50 trillion rupees in the next 8 years. In the last 3 or 4 years, the domestic institutions have pumped in 15 trillion rupees, which is almost 8 times, 9 times more at the rate at which it has pumped in money over the last 8 years. So developing the cash market is very important. To develop the cash market, you need more paper. The next is you need more free float of the old way. If we don't do this, we will create bubbles. And we don't want retail investors to buy into a bubble and get disappointed and go away. So every step you see is into these two buckets is what I classify. One is develop the already listed paper. India has only 6% of NSE 500 companies have 90% free float. Okay, it's exactly the opposite for S&P 500. S&P 500 में 95% कंपनियां 92, 93% of the companies have 90% plus free float. Here we have only 6% who have 90% plus free float. And we frown upon promoter selling. If promoter doesn't sell, how will price discovery be fair? If promoter is gobbling up and holding 70, 80%. So I think that needs to happen. And the anchor investor quota becoming higher. Because today retail quota is also increased. But IPOs, which are great new businesses which are coming in, most people are using in the retail and the individual space to flip it in the first 3 days. Now, if you have got on to, if you've done so much
Hmm.
research, bought a good IPO, at least realize its price. Right? I realized this when we had got listed. Before our bell ringing ceremony was over, the volume traded was greater than the number of shares given to the market. I was so surprised. That was a revelation for me. Did people realize my stock went up 10x in 4 years? But nobody actually who actually did the research and bought it were they actually investors? May or may not be. So I think IPO market also needs to develop into a long-term market rather than a short-term listing gain market.
Hmm.
So I think that's how I see that. But the great part is also on the new investor initiative. You see that they have brought
Hmm.
in an incentive for newer investors. If an investor from a tier 2 city or a tier 3, apart from the B30 cities, if a distributor brought a new PAN to the industry, he gets additional 1% commission on his first 12 months SIP capped at 2000. This is a great initiative. Like that, so
Hmm.
several initiatives have been taken. Initiatives have been taken for PANs which belong to women. There will be more distribution commission. Right? Today, you go to a sub registrar, you get a discount if I register the property in my wife's name. Similarly, a
Hmm.
distributor gets more commission if he brings a lady in. All these small things are very strategic long term initiatives. So I loved the board meeting minutes.
Hmm. All right, so that's an exhaustive answer of the entire, sweeping changes or the no changes in norms that was announced by SEBI over the weekend on Friday, so to say. But let's talk about pockets of value now. Autos. I want to get in your thoughts, given the fact that we've seen quite a bit of an up move when it comes to auto names, especially since 15th August announcement by the Prime Minister. But back in 2008, the when the government slashed excise duty on automobiles by 4% or so, we saw that resulted in a 20% up move in auto sales across categories within a year or something. But this time also, auto stocks have gone up anywhere between 6 to 15, 16% already since August 15. But do you see this just as a start of an upward movement in these stocks? So do you think that much of these GST related announcements are already baked into the price? Where are you? Where do you think we are in the upcycle or re-rating when it comes to auto stocks?
See, the last time I was there, I told ABC. I think it was a month and a half, or even more behind. ABC, auto, banking, and consumption were the three themes we were looking at, and I think that those have panned out over the last quarter reasonably well. Whenever we look at sectors, we look at how can an investor own it, not a trader own it, or investor owning it should have only one objective: can it beat Nifty by 3 to 5% every year for the next
Mm.
2 3 years? If that's the criteria, then go the sector way. Otherwise, diversified is the best way to go. Now I'm adding D and E to it, drugs and energy, renewable energy especially. So I think ABCDE is the theme which you can look at. Firstly, but
Mm.
coming back to whether the GST thing has played out, I personally think no. Like the corporate tax rate cut, it has been done a few years back, still benefits me as a corporate
Mm.
and several other corporates and their earnings. These GST cuts will have long-term impacts on consumption. And no 5, 10, 15% move can price that in my opinion. That's my strong belief. And I think if you have a portfolio of consumption, for example, I think most of us we use lingo which does not get interpreted. I was listening to two oncologists speaking in their lingo about a patient. It was so intimidating. Consumption is any business where you sell from a business to a consumer, and I'm reasonably bullish on that theme as well.
Mm. Okay, what about metals? Last 2, 3 months when the markets were underperforming, metals were doing well. And of course, we also have this whole theme of China involution, wherein they are curbing, cutthroat competition and reining in capacity, right? Uh, Metals are being seen as the big winner of that. And of course, we've seen the dollar index also is softening, so to say. And of course, we also have a Fed rate cut coming through soon enough. So how should one really look at metals? Do you think should one look at both ends of the spectrum, ferrous, non-ferrous? Should one play this theme for the next year or so?
Depends on how smart you are. Anything which is cyclical, you need to have some data about your capability to enter and exit. some businesses require a certain temperament. I think that's where metal would fit in. The kind of cyclicality or the cycle frequency is so low. The amplitude is so high. The frequency is also high in terms of its peaks and trough. That cyclicality is a business I would not recommend people playing unless you have shown the temperament. At least the last 10 decisions of yours have gone right in terms of entry and exits. Most people evaluate themselves more liberally and evaluate a fund manager more stringently. That's what traders end up doing, and that's the non-mathematical way of managing money. So anything cyclical, unless you have a case of hypothesis checked on yourself, that your temperament has permitted to get in and get out of cyclical stocks, you do not touch it, ideally.
Hmm. Got your point. But there are some other beneficiaries as well, right, out of this whole anti-involution drive. Some EPC companies, solar energy, etc. Any of those names, or would you expose yourself to those pockets now?
The renewable energy will definitely be one which, as an industry, if you look at an industry, if you look at a sector, you should see how the emerged markets have played. So 10 years later, would we be selling more cars? The answer is yes. So you have to. So if you speak of energy, I would say renewable energy is a subsector which I would be reasonably bullish from a 4, 5, 7 year standpoint. How we would go would be how the US is today.
Sure, got your point. A couple of more questions then. Feroze, how are you looking at the entire precious metal, gamut, and how should one really expose themselves to precious metals within their portfolio? Gold is, hitting fresh highs. Silver is where it's at. Prices can't really be, one can really not catch these prices. So how should one really play into this rally? And how much of a portfolio composition should consist of precious metals now?
See, precious metals or any asset, firstly, you should have some basic filters in life of what will I buy with my hard-earned money. Any asset which has given you 10-year negative return in a high inflationary economy is never going to be an asset for me. Silver has done that. Okay, so otherwise you will always be buying it at the wrong time. Silver has, for 10 grinding years from 2011, if I remember right, it had touched some 77,000 rupees to a kg, and then it languished for 10 years. Agar India mein, if you don't make money for 10 years, you have lost 60% of your value anyway. So silver, I don't even call it an asset because it has not passed this litmus test. Gold is a very important asset for an Indian because Indians love gold and they love FDs. Anybody who's got FDs, he was better off in gold and significantly better off in gold. So if you love both assets, at least be in the better, the asset which reserves more love. If you don't have debt in your portfolio like we don't, I don't recommend to my clients gold because their portfolios for the last 11 years have delivered 15.5% on the overall asset, including in every asset they have. So I don't have any regret of not having gold because the last 5 years IRR, if you chat GPT it, 1 year, 3 year, 5 year, you will get 5 years at 13.5. So if you are a debt investor, at least have half your debt in gold. Because what global transformation we are going through will create a reasonable buoyant dollar gold environment for gold. So dollar gold had got stuck below $2,000 and that broke out. And that's the great news. And I think over the next 10 years, the kind of geopolitical situation has panned out and how countries are gobbling up gold in their treasuries, I would be reasonably bullish that it will beat debt hands down. And that's what any debt investor should put half his money in gold. In the form of sovereign gold bonds, we got a hand on the secondary market or even gold ETFs.
All right, that's the view then. But Feroze, any thoughts on those looking to invest in defense names because of late defense has once again seen some buying interest. Of course, you mentioned the ABC of consumption and how of course consumption plays now gaining traction. But for those looking to enter into defense now, would it be an opportune time?
See, the valuations are still stretched, but it's significantly better than buying it at the peak. Why am I'll again bring you back to consumption because you should never look at more themes. You should decide which is the one best theme you can go for as an investor. Because themes might be interesting, but you can't play 5 themes. Then you're better off playing diversified because 2 of them will not pan out. This is the first time I am seeing that there's a theme which has become so popular and so much decibel, and the last 1 year return is minus 2% of the 27 consumption funds in India. अदरवाइज जब भी वो थीम की बारी आती है, इतना बातचीत होने लग जाती है, तब तक if you look at the rear view mirror, they would have beaten Nifty by 20%. That's what happened to defense. People bought defense at the wrong time, where the rear view mirror had already delivered 50-70%. So the 27 consumption funds in India are at minus 2% average return for the last 1 year. And the consumption theme, decibel is so high, but the rear view mirror is not so good. So that's a good combo. And I think that's why I would say a lower risk consumption would be better than defense.
Okay, lower risk consumption better than defense. That's the call. But with that, Feroze, lovely chatting with you. We discussed an array of topics and love to have your thoughts and perspective on each one of them. Would like to, again, of course, interact with you sometime soon. Have a great day and hope to see you soon.
Thank you, madam. Have a nice day.